So I think we have to just start with the news of today, that debt ceiling deal framework. It's the framework. It's not done just yet. How are you looking at this? How concerned are you about the possibility of it going to Rules Committee and maybe not passing?
So we have very limited concern about that. I think the negotiation was probably the toughest part. And now we've moved past that hurdle. I think there is a little bit of optimism, certainly in the market. You can see that there's been a slight rally as I look forward to the idea that this has been, we won't have to be facing this again, at least for another 2 years. So not much concern, but of course now it's turning back to the really fundamental factors that were facing the US economy even before the debt ceiling saga began.
So very interesting there. So one other thing I want to talk to you about right now is the Fed. So let's just say hypothetically, this debt ceiling deal is done and we can move past this. We have a Fed meeting coming up in 2 weeks. A lot of thoughts about what the Fed might do. When you look at the CME FedWatch tool, it's kind of a split decision on whether we're going to see a pause or a hike. What's your opinion? Do you believe that a pause, is that critical to see an upside move when it comes to the markets?
I think the market would be very concerned if they see another hike coming from the Fed. And it has been interesting because really the market has moved up and down about this for the last couple of weeks, initially suggesting that a pause is almost a fully given certainty. And then with the last couple of weeks, as you started to see quite hot economic data, higher than expected inflation, some of those concerns have started to return. And now you have over a greater than 50% chance of a hike priced in by the market. It won't take too kindly for that, because I think there is a lot of hope in the market at the moment that not only would you see a pause, but you could even see rate cuts starting within a couple of months. So that would undo a lot of the optimism.
All right, one other thing we're also concerned about, even with the possibility of a deal, is the U.S. credit rating being downgraded. All three of the big rating agencies have put out basically a warning for the U.S. credit rating. So if the brinkmanship has pushed us to the point where we're going to get a warning, what is this marriage of convenience? What does it not only mean for our credit rating, what does it mean for the markets going forward when it comes to the debt limit deal?
Well, it is quite interesting because when the US was downgraded a number of years ago, obviously the market response was very negative, but it did pass quite quickly. I think the important thing is, get this deal done, and then even if there is a default, of course, it would not be a positive development for the market, but it would move on fairly quickly and again return to the other more fundamental factors facing the US right now. Now, certainly, given that we have moved forward with this, the ideal situation is that downgrade does not come, but it's something that we need to just keep an eye out for.
All right, one other question. When you look at bonds right now, are you still focused, or and I'm not going to say you, but do you think investors should still be focused on the short end of the bond curve right now with the 1 month providing that yield, or is it now the time to maybe lock in that yield with a longer term bond?
It's a great question. So I think now that we've moved past the immediate concerns, you are starting to see a lot of interest again within that short area. For us, actually, the broad fixed income market seems very interesting. And again, not just in terms of treasuries, but even as you look across to the investment grade market. So I think there are a lot of opportunities, and it really depends which security you're looking at. But again, across the curve, there are interesting opportunities.